I would like to welcome you to our webinar. Thank you very much for joining. My name is Lukas. For 7 years, I am helping companies from banking, insurance, automotive, retail industry to use their data. And today, I will tell you something about improving selling campaigns with propensity modelings and how to increase selling loans with some advanced modeling and advanced data usage. We start with a brief introduction, a little motivation, and then we will talk about data and what kind of data is the most useful and the most interesting regarding to data-driven lending, and then something about how to use this data, how to approach data-driven lending. And the grand final will be about how to turn it into profit. Between those short blocks, I will always make a very short break. During that break, we have some polling ready for you. So if you want, you can take part and you can answer some very simple question, and then we can discuss it for a couple of minutes, and then I will always continue with the new block. So I hope you hear me, and we start with why to be data-driven and why to have data-driven bank. I like this quotation, banking everywhere, never at the bank. It's from a book by Brett King. Maybe you read this. It's the book is called Bank 4.0, and it's basically talking about the vision, how banks will work and how they will look in the near future. Actually, it was, of course, written before the COVID situation, and now we are pretty much in it. So it's not a near future anymore. It's a reality. Definitely, it comes from the idea that banks are not as the same old institutions, and now they are basically IT companies. We are not visiting bank because we withdraw cash anymore. Of course, nowadays we don't even go there. We are just sending our data, and that's how we are interacting with the bank. I will preview the first polling question. Actually, it's a little bit provocative. Isn't the data in a bank's warehouse more valuable than the deposits of clients? Think about it a little bit before giving a straightforward answer. Maybe think about very low interest rates and think about how data is important to do cross-selling and to sell other products like loans and insurance and stuff. So we will get back to this question later, and you will have your opportunity to show your opinion. But back to the topic, we were talking about that people now are sending data. So the relationship between bank and the clients is very different now. We would like to do private banking for everyone, and now actually it's more possible. We just use the data as the medium, and of course, every client wants basically to be served anytime now, because they are doing the banking from the phone or from the computer, maybe when they are lying in the bed in the evening or during the weekends, and the clients expect that bank will solve all their issues. And for that, of course, bank needs to work with the data and the responses that a lot of data teams, big data technologies, data science are now being involved, because this data competence is really the key to successful partnership with a client. And actually, it's a mistake to think that only the technology is the driver of data-driven banking. We always need to think about that banks are doing this to fulfill some set goals, and everything needs to be according to some good strategy and following some business cases, because doing data analysis just for data analysis is never good. Like data analysis should be to get some data, to get some value from the data, and for that the whole mindset has to be changed. And actually at the end it's people who are driving the data driven banking. Talking about mindset, I have here few examples of what we call actually frozen mindset, and think about how often did you approach this. The first one we hear very often is that the customer doesn't need to be bank, any industry, don't really want to do anything data driven because they think they need to focus on a core business right now. The reason is usually that they are doing too well or too badly. And from this point of view, imagine a automotive company, like someone who is making cars, let's say in 70s, and they are selling well a lot of cars, but they are not working on any good engine, because now they are doing too well and they need to deal with the operation and how to build new factories and get the better sales and stuff like that. So yeah, definitely this is not good strategy, because 20 years from this situation it will be all different, and if they will be still selling these old cars, they will probably be successful anymore. So it's pretty much obvious that data it's strategic things. The second thing I am approaching very often, it's my favorite actually, I heard it maybe like 20 times already, that institution tends to be a special case, and they basically think that this kind of approach is not for them, and they don't even trust. The reality is that if someone is a special case and is unique, the business is the way how the business is done is unique. Probably this company is a unicorn. It's really like the leader if they are special, and this is not usually happening. And the truth is that the way how you can use the data and to improve any area of your business, it's pretty much repeatable, and there is always some possibility how to improve something. Data is not making decision. Artificial intelligence is not making decision. It's people, but they can use these tools to make better decision, the same way as they started to use calculators and computers, and now they are more advanced stuff. But to having the right data for your decision is the key. So it's not really about intuition. And finally, and this is concerning banks a lot, data sometimes cannot be used in certain situations. And this is very common argument. The data isn't allowed here to be used. And we all know GDPR and those regulations and restrictions for not only banks, and in banking sector, it's many of these regulations and restrictions. The fact is that these regulations, like international regulations or national regulation, doesn't usually say that data can be used. And very often this is actually the policy of the company. Like even in the same country, different banks are approaching data different way. So and the fact is that actually every large company and every successful company is using data somehow in compliance with the existing regulation and restriction. So always ask which data cannot be used and for which purpose, because no restriction is absolute. So this was the first block. I will try to launch the polling here. So you should see it right now. And if you want, you can show your opinion about the first question. Great, I can see some responses coming. If you have any questions, please use the question and answers bar, and we can discuss it. After each block, we will have a few minutes for discussion. So if there is any, please don't hesitate. It's actually it is very surprising that the majority of voters think that the data is more valuable than the deposits. It's great to see. In my opinion, maybe, of course, we are not yet at the state where data can be monetized that easily, that straightforward. So I would vote for deposits right now, but I believe this will change pretty fast. And it's really like 66%, 2/3 for yes, and 1/3 for no. So interesting. Great. Okay, it's not changing anymore. So I will end this polling. Last seconds, last chance to vote. And we can actually move forward. So now let's talk about the data and how they can be used. So we were talking about that this desire of Bank 4.0 is to have a relationship with its customers, stronger relationship, and the way how to achieve this is to use data, right? So how to approach this? If you are familiar with data science or data modeling, you probably know what you can see on the left side, the framework everyone is using, and you basically collect all data about the clients you have, create some client metrics, and derive certain statistical features, and build some model over it, and do any type of scoring, churn, propensity scoring, or risk score, or anything you want to model or predict. What can be added to improve this? Because actually it's not easy to improve the models if you are using the same kind of data. So the idea which I offer here is to use transactional history. So not just the regular metrics, but basically anything clients are doing, and build behavior models from it. Not to be abstract, I want to show you some specific example. What I mean. Here we did some nice analysis over ATMs data. ATMs withdrawals, probably the most boring data in the bank. What you can see here on top is just like a time series, the average time series of the average ATM, how withdrawals go. You can see the peaks in the working days and some lower activity during the weekend. The idea is like, let's break this down. Let's break this time series. Let's make a time series signature for each individual ATM, and let's visualize this data. Let's project this data and plot it. And each dot you can see here on this, what we call UMAP, each dot here is a single ATM. And this UMAP visualization has the feature that those ATMs with the similar time series signatures are close together, and the more they are like farther, the less similar they are. And we already can see some similarities among certain groups of ATMs. For example, here we have ATMs in the capital cities. They are together here. ATMs that are somewhere in subway are in this little area here. Or we can look, for example, ATMs that are used more by males than females, and they are here. And from this, there is the idea that you can actually look for some clusters here in ATMs and check for some characteristics, and then you can discover interesting stuff. This little peninsula here, actually the one that there is the majority of males withdrawing the money. These are factory areas here in Czech Republic. We are making, we have an industry, we are making cars and stuff. So these are actually the names or the addresses of the ATMs, and you can really see these factories here. And they are specific with the peaks because they copy the shifts, the working shifts of people there. Another cluster is for business centers. Those are, for example, those like in the capital city, banking districts, and again, specific peaks. And a different cluster, we really like this one. It's a party ATMs in the party streets, nightlife, and they have specific peaks on Friday and Saturday night. So the idea here is that this is not really about ATMs. This is about clients. This is about people using ATMs. And if someone is using the same ATM as someone else, there will be some kind of relationship between those two. And luckily, we don't have only ATMs data. We don't have only ATMs transaction. We have a lot of transactions. We have payments, card payments. People are traveling abroad, so you have specific payments. You have money transaction between two clients. You have salary, incomes, the transaction between the client and his employer, and online shopping. And this will give you really a network between people. It will connect people with similar behavior, same as with ATMs, with all the other usual day-to-day lives. And this is how you can actually view your client, not only his data about him, but the data about people who are close to him, who have the same behavior. This is also pretty much same as the real social context, but those people don't necessarily need to know each other. That's why we call it pseudo-social networks. And this is the approach, like just the overview from the transactions, from the client data. You find out similarities between people, between pairs, or among some groups. And this will enable you to create a holistic view about the customer when he is in the center. And this is his pseudo-social background. This is his pseudo-social bubble. And you can call it also microsegment of one. And this is some extra information you can put to your models. And this is something which can improve the accuracy of your models, including propensity scoring, I will be talking about very shortly. So just an overview, maybe you can find this interesting. These are data that seems to be the most important for propensity modeling, for predicting loan sales, and for targeting people. The regular client data, social demographic, age, region, education, or any kind of risks scores and other scores that already exist. The client data in the bank, their product history, some like aggregated data, balances about their accounts, current accounts and saving accounts, transactional data. Every transaction data you can collect, card payments, any in-out transactions, and the micro-segmentation using these data, like spending behavior, it's a key. When and how and how often and how much clients spend, their mobility, where they are spending, and how fast they are moving, and what distances, and how is their day, and the regularities in their behavior. Use of services, prepaid services like Netflix or using mobile phones, any kind of regular services also will show the connections between people. Salary and incomes are very important. And of course, the real social background, family, households, and friends. So if you have any questions, please let's discuss it. I will do another polling about the usage of data. So I'm really looking forward to what you think about it. The question is which type of data sources I was showing to you you are using for any purpose. For any purpose you are using client data, which kind of data you are using. And I have also one question here. What's the best way to get access to use the client's transaction data? We have a hard time since it is under strict regulation. We have for a long time wanted to use it, but haven't been allowed due to local and European Union regulations. Great question. I have to say that I'm pretty sure that due to European Union regulations, it doesn't mean that you cannot use transactional data. You can, because we are using them, and we are with our clients, banking clients, who are using transactional data in the European Union. So it may be some specific case of the local regulation, but again, usually it's not absolute restriction, so it may be also about our banking policy. But what is important to have a consent of your clients to use this kind of data. What is good thing about it that you can always use transactional data as long as it will be anonymized. So you can create these holistic views, and then the specific clients will be just numbers, and it will anonymize that way that it won't be even possible to uncover who is it until the very last moment when you then de-anonymize this. And you can do it only for clients that actually have where you have the consent to use this kind of data for marketing purposes. What is the required history of transactional data? For different use cases, the different history length is needed. Sometimes it can be 3 months, sometimes it's a year. For example, for discovering the salary, to do the salary detection and this kind of behavior, incomes and salaries, 3 months is a minimum, and then you can also, or 2 months, and you can also use the PSD2 regulation to get this information also from like an external source. For some more complicated analysis, maybe 6 months, 1 year. And final question is, can you explain about social network analysis with data-driven approach? Here, what I am talking about, it's not the social network analysis like Facebook or LinkedIn. I am here more talking about the pseudo-social analysis, which means people with similar social behavior. And the way how to use this, how to approach this, is basically collect the transaction and create and show this connection in some kind of like a graph. You will need a big data solution for this, and then distill the information and do clustering on these. And you can use various techniques how to do this. We really like graph embedding, which is the cutting edge thing, and this will help you to very nicely turn the transaction into the information about the client and his kind of like a proximity to other clients in the bank. So maybe in the next chapter, I will show you how to use this for business, because I believe most of you are most interested about how this can be leading to data-driven lending and to propensity scoring. Okay, so the vote is done. The most of you are using the client social demographic data and aggregating account data, and actually the behavioral data only 41%, but maybe it's quite good. Maybe it's a little bit more than I would expect it. Great, thank you very much for your answers. So data-driven lending. Let's say you have this transactional data and client data as an input, and what you want to do is to target loan offers well at the right time to the right person with the right product. And we discovered 3 ways how this can be done effectively. The first one is event monitoring. Once you can collect transactional data and other data which will reveal behavior, and you can watch over moments like a new member in the household or change of employment, the race, income race, or change of spending habits. You can connect it with some kind of like event triggers, and when this happens, this is the opportunity for loan offer, and this client can be put into campaign. And the process can be data driven, the way that this is all happening automatically. The data are monitored automatically. The triggers are actually not just like showing red flags to someone who will put the client into the campaign. It can be, but it can also be done automatically. Here in Czech Republic, there is nice small bank. It's actually like a franchise of some international bank here, and they are doing this, and they are automatically sorting clients in tens of hundreds campaigns running simultaneously based on these triggers, and it's very easy and it's actually very effective. The second way, quite specific, is actually not to look for clients who want to take loans, but to look for clients who already have loans somewhere else. And you can do it by detect the installments in their transactions. And I want to say this can be quite trivial. You can look on certain bank accounts of the competition and for this, but it can be also very complex. And you can also discover installments to non-banking organizations, to private persons. And once you detect those installments, it's the opportunity to loan refinancing. And there is one dimension in this, which is great. We love this. This is something which can be very, very helpful. You discover some not really very favorable installments of your client, and you can help him with refinancing and improve his situation. We did this analysis and detection with our partners in Raiffeisen Bank, and this was a great start, because this is how bank actually can really help the client with his data. And the last way is everything I was talking before combined. The important here is that you are using the data on day-to-day basis, and you are computing the propensity to buy score, which is the prediction of affinity or somehow like scoring the affinity if client would like to take the loan. And you can use your behavior models, you can use pseudo-social modeling, you can use transactional, anything you have client data, and count this score on day-to-day basis. And then you can rank the clients, and you can always choose right clients for the right product for your offers. Speaking about this propensity to buy modeling, as I said, you take the input data, the one I was talking about, And the outcomes is the score for each client individually. This score at the same time is the probability. So you see 90%, 80%, 60%, that the client will take certain product. If it's propensity to buy, it is just like the general name, but you can do it for consumer loans. We call it propensity to loan, but you can do many models like that, many propensity models. And as long as you have the ranking, you can always say this client is more suitable for a certain campaign than some other. Technically, if someone is into the technology, I just want to show here that this is the propensity model is any other data science model which is running on your data science or big data platform. And what is interesting here that this score is actually the output to your campaign management tool. So we are not talking about some new campaign management tool, some new campaign management system. We are just talking about getting a new input for your campaign management system to improve the target pool, to improve the recommendations of products, to make your call scripts data driven and provide information what can work the best way. So this is how it's consumed. And of course, to be able to run it on day-to-day basis, it has to be in production, it has to be governed. That's why I'm mentioning here DevOps engineers and MLOps, because without the right integration into the bank IT infrastructure, it cannot work properly. So it has to be all governed, and you have to always know why the score is given as it was given. This is very important also for auditing and compliance. So let's look for your other question. I will start the final poll we have here. This is about the model consumption. Basically, I would like to know if you consume outputs of data science model in your tools, any kind of tools, maybe campaign management system, maybe anything else. And let's check the questions. This is a good one. The client's data is available for what I'm talking about. How about how to handle non-client's data? Yes, the thing I was talking about is based on the fact that you have the data, but thanks to PSD2, you can actually, with the client consent, of course, you can get the data from his or her bank outside, external one. You can get external transactions. And this is actually a great way how to, for example, not only do propensity modeling, but to do risk scoring when you are accepting new clients. So thanks to this PSD2, this is no more collecting the dozens of papers and going through the bank accounts history printed out, but you can actually connect and collect this data. Sometimes this is very helpful just to optimize, but you have to realize that this is the way how you bring new data into your bank, even for people who are not your clients. What is the tool? I think PSD2 you are referring. This is not the tool. This is actually the regulation which saying that banks have to share the data if client agrees. So you can get the transaction history of clients. This is actually European Union regulation. And it is compliant with GDPR, the same rules apply. So if you collect this data this way, you have to behave still them very carefully, and the GDPR applies, of course. Great. So this is great because only 16% of people cannot consume any data science models outputs. It's a great news. And 42% is going to do that very soon, and 42% is already using. So that's great. Happy to hear that. So let's go to the last chapter. It's about monetizing this thing. From the business, from the sales point of view, how to use this kind of propensity to buy score modeling or the score if you already have it. This is basically campaign selection tool. You usually have some fin channel that you are using for contacting clients. Mostly it's a call center, and let's say that in your case 20% of clients can be directly contacted by a call center every year, and you want to use this channel effectively. It means that you want to select this 20% that will respond well, and you don't really want to call and waste time on people who will not want the loan. This is pretty straightforward. So you want to maximize the response for the amount of people, which is the capacity of your fin channel. Or sometimes you are thinking about that you can increase or decrease the capacity of the channel, and you know that just some certain fixed response rate will cover the expenses, and anything above is actually working well. So again, you want to make the response rate as high as possible, and you will use your model to achieve this high response rate. And the most complex, most sophisticated way how to use propensity scoring is to actually compute propensity score for different products and then compare. So you will have propensity to loan, propensity to mortgage, propensity to some investment product or some cross-selling products like insurance or anything else. And at the time, you can always compare these propensity scores for each client, and then you can choose the right product. So now let's talk about the value, what it brings to your client base. Like every bank has these three groups of clients. Clients that actually are not really interested in loans because they are, for example, savers. They have saving accounts and they use bank only to save money, and they are not really responsive to loan offers. And also a lot of actually non-active clients that are not using the bank at all. And this is usually about 20-30% of the client base. Of course, it depends, but usually the situation is like that. And on the other hand, you have the regular borrowers, people who are taking loans all the time. They know how to handle money, they are educated, and they don't need any loan offers. They will take it in any case, because this is just how they behave. And then the most part of the population is your mainstream clients, the rest, and of course newcomers, because those are clients you usually don't have enough information about. So they come with this group, and this is the largest one, and this is basically like really the gray zone, because you don't know. There will be clients who will be very into loans. There will be clients who will not be at loans at all, and this is where the nuggets are, and this is where you do your cherry picking. And you have like the baseline of each group is different. I mean, the baseline response rate, how they are for the regular borrowers will be high. for the savers, it will be almost 0. It's like not really known here. But once you will start an approach, a model, anything smarter than just like a random calling to people, and every bank is using some approach, maybe rule-based, maybe some simple regression, anything. The value will be the highest in this mainstream, in this result find out. Here you cannot find out too much because you know that they don't want loans. And here you cannot also find too much because you know that they want. So the model itself will not help you that much. And if you improve this model by using some advanced techniques and data, transaction data, behavior models, again, the improvement will be most significant for here, for the most of the clients, for the mainstream, and not so high for people who are taking loans anyway. You can target them pretty easily. The model will not discover anything new, and it will not be as well that much high for less active clients. And if we are really talking about, we have a simple monetization. Great. I hope you can see my screen again. Yeah. So we have a small monetization example, and this is involving like few variables. The first one is the capacity of the channel. So how many clients do you have, and how many clients are you actually? Is it possible for you to involve into some campaign with the specific channel? The baseline response rate of this channel, for example, for a call center, it's usually around 1%, 1.5%. People will react positively to the loan offer. Will react positively to loan offer if it's just like a random targeting. I can see. I hope that now this is working right now. Can you just please type me to the chat if you can see the presentation right now? Yeah, great, perfect. It seems it works. Sorry once again for the inconvenience. Yes, and then you have the lift of this response rate. So if you are not choosing clients randomly, but you are using any kind of model or any kind of way, how much better, how many times better you are comparing to the baseline? Maybe 2 times, maybe 3 times, maybe 5 times. And then you have unit income, like what does it mean to sell one average loan to an average client, and how much money do you make on it, which also differs. So let's look at something we call the lift curve. And here we have the situation that, let's say we are interested in top 10% of clients, like this is our channel capacity. And here is the whole client base, and we have some baseline response rate, which can be maybe 1%. And the bank is using 2 models, the blue model, the traditional one here. And you can see that the lift curve here is actually saying that the narrower the group of clients I want to select, the narrower it is, the smaller it is more important to select it right. If I will randomly call to everyone, and if I have a model which will choose everyone, it's the same, right? It's the same. It doesn't matter if I do it by model or if I just take all. It will be always the same. But if it's half, it will be more important if I have better selection. If it's 20%, it's even more important. And if it's 1%, it's crucial. How do I select the clients? And here I am interested in 10% because this is my capacity, what I can do for the campaign. And one model perform, let's say here, I don't know, 4 times better than the random response rate, and the second model, sophisticated with behavioral modeling and using transactional data, is maybe 7 times better here. Yeah, and this information is actually enough to compute, just like some kind of like an estimate, what will be the difference of using those two models, and what will bring you to use model 2 over model 1 instead of model 1. Because if we actually multiplies, I have information that I'm not sharing properly. I hope it's better right now. Yeah, so actually, if you put together all these variables you have here, and you will multiply the channel capacity, let's say 10% of million clients, if you have million clients, and the response rate, the baseline response rate of random targeting will be 1%. And if, for example, the better model will perform 5 times better and the worst model 3.5 times better, and you have some average unit income, this is, for example, number which applies pretty much to Czech Republic. This is like the average unit income from the consumer loan sold. You can figure out how much can bring you if you use model 2 over model 1. I know that this is simplified situation and there is much more variable, but this will give you the basic framework how you can think about it. The last thing I would like to show you actually is a nice case study we did together with our partners from Equabank, which is Challenger Czech Bank, and together we did propensity scoring, and we were predicting who will take who of the clients will take a loan in next year. And we did it for 400,000 clients, and we counted the probabilities, and we turn it into the score. And this is basically the situation when we look at it when we were evaluating. So this is all clients and the score computed for those clients. And this red part are actually those clients who really got a consumer loan in the period of time for evaluation, 12 months. And as you can see, the model here is working because those clients with the higher score, the ratio of taking the loan is getting higher and higher. If you transform it here just to the ratio, you can see that the clients with the higher score actually took the loan with the high probability in more than 50% cases. For example, maybe this will be around like the top 20, top 30% of clients. And if you are into data science, you know these metrics, how to evaluate models. So the numbers are pretty high. Maybe for some of you will be better to look at it from the business point of view. If you take clients with the highest score, top 20%, they are represented here in this dark green line. And you look at them, these are with the predicted, with the highest score, with the highest predicted possibility. In 2 months, they took as many loans as the rest of the clients combined within 1 year. So it's showing that if you do the cherry picking and if you use model to pick top 10, top 20, top 30% of your clients, you will really discover those that will respond very, very positively to the loan offer. The evaluation was done by the data science team and the analyst in Equabank. So this was their expert evaluation, and they also did it not only for the whole client base, but or on some clients segments they are using. They have active clients, they have clients with saving account, they have new clients, they have non-active. These savers, and these are people who are actually not clients anymore. They don't have any product right now, and it's interesting to look on the success rate for those groups separately. So the model was working pretty nice, not only for active clients, but also for the new clients here. If you look on these are like the lowest 5%, the lowest 10%, the lowest 15%. This is highest 5%, highest 10%. So if we look the top percent clients with the highest score, we can actually see that 4 to 6 of 10 clients, top percent active, took the loan. For new clients, it was between 35 to 50%, almost 50% of new clients with the highest score took the loan. So it's showing that the model was working very nice. And just the summary of this, the situation I was talking about at the beginning, there are clients who are frequent borrowers. It's actually just 1% of the whole client base. They are taking loans. They don't need to be offered. And also the scoring is not really working very well here for them, for this 1%. On the other hand, we have those who are not really active or who are like savers. As you can see, the amount of loans sold to this group is low as expected because they are not really interested in loans. But at the same time, the predictive power, the accuracy of the model was still pretty high for them. But of course, the model is mostly working and actually very well working for those for the rest of the clients. For the mainstream, for the almost 70% of clients, the accuracy of the model is very high. Well, even with this inactive and savers, it makes sense to put them into some campaign because you can predict and you can do the cherry picking even here, but the value will be the highest for the 70% of clients from the client base. So this is the last thing I wanted to share with you. Now it's the time to answer the other questions. So please, if you want to ask anything, just put it in the QA. Yeah, again, the question about PSD, PSD2, it's a regulation. If you look like a PSD2, it's the regulation that banks can share data, and then there are many tools, and technologically it's possible to use this protocol and to get this data, and this is a great source of external data. Another question is, what approach do you recommend to make the propensity scores of the different products comparable? As long as propensity score is a probability which is standardized, you can actually compare it. It's comparable. So you can compare if you have for the product number 1, the probability 56%, and for the product number 2 is 78%. You can say from the mathematical point of view that the second product will be better to offer, and it's absolutely okay because those scores will be standardized the same mathematical way. How frequently are these models refreshed? The model refresh, if you are asking about how often this is counted, It makes sense to count a new score quite frequently. It doesn't maybe need to be every day. It's a good idea to do it, but if it's once a week, it's fine. It doesn't really make sense to count it just like a yearly. You want to have up-to-date information. But if you are talking about the parameters of the model, the setting of the model, of course, you have to always check the model, how it is performing, if the situation is changing, because the model will not react well if the situation on the market will change rapidly or something like that. So it needs to be recalibrated. And it's absolutely necessary to have these processes set up into your environment. That's why I was talking about the ML ops. And you have to watch over on day-to-day basis how the model is performing. And if you see any changes, significant changes, the calibration need to be done. We always recommend at the beginning, when the model is new, any new model in the banking environment should be recalibrated every 3 months, the first year, and then every year checkup is absolutely necessary. But there are special events like this pandemic right now means the situation is changing rapidly. So if this kind of event occurs, it needs to be calibrated. If you have some kind of like a solution like let's call black box solution, something like that, it might be very difficult to do the calibration. Sometimes you need to change the whole solution. If you have the model, transparent one, and you know how it works, sometimes changing just few parameters is possible, and the model will work well again. But the key is to always check the performance of the models and use the ML ops in order to watch over this, not just to do some kind of like analysis like every year how it works or like that, because it's not enough. So I actually cannot see any other question. If you have some more, please let me know. I would like to ask you actually about one more thing. First of all, thank you very much for joining and staying with me. We would like to get your opinion about our webinars. So if you find 1 or 2 minutes, you can scan this QR code and fill some very short survey about it. And if you have any other questions, or maybe later you find out something, you can contact me directly on my email, or you can visit our webpage, bigdataforbanking.com, where you can find a lot of information about propensity scoring and other data-driven solution. So as long as I cannot see any other new question, I would like to thank you once again, and I hope we will see you soon on some other webinar. Thank you very much. Goodbye.